September started off with a market sell off, with most stocks down 2 to 10% in just a day. Here to break down what's behind the dip is MarketBeat analyst Thomas Hughes. Thomas, I don't think anyone was hoping September or their return from Labor Day weekend would start out quite like this.
Well, I don't think anybody wanted it to happen, but it's been pretty well telegraphed by the market. We've been anticipating at least a volatile September, and right now it looks like it could be a significantly down month.
Just how down did we see stocks tumble yesterday?
Well, the S&P 500 fell 2%, so as an average. So most S&P 500 companies, including the leaders like Nvidia, fell much more than 2%.
Let's talk about Nvidia. They've had a really rough week since their earnings report, which was actually pretty good.
Right, the report was great. It was what the market wanted, but the market was expecting it. One thing, the market pricing in the peak of AI growth, but it's being compounded by sector rotation, which is ultimately why the market sold off yesterday.
So, how far has Nvidia fallen since earnings?
Yeah, so Nvidia's down 25 to 30% since the earnings report, and it could possibly move lower. Right now, Nvidia is still amongst the most crowded trades on the market. Everybody's been buying that stock for the last 2 years. And with sector rotation in play, it's possible that the sell-off could continue for many weeks until the last person has been able to get out of their shares.
So let's get to what's behind this sell off. Why are people selling this strong company and others too?
All right, so let's back up. The sell-off on Monday is really an extension of the sell-off that began in July with the CPI report. Now, the CPI report was cooler than expected. It aligned with the idea of the FOMC cutting rates, and since then, the FOMC has indicated that rate cuts are very likely. They may not cut them this month, but they are expected to cut rates before the end of the year, which signals a shift in economic policy and fundamental quality for the market. And what that means is easing headwinds, which is expected to lead to growth in the small cap sector. So, back to sector rotation. People need to sell out of the winners that have been winning for the last 2 years, which includes Nvidia and most of the big AI names, in order to prepare to buy small cap stocks.
So last month, when we saw a similar dip, there was a huge rise in the fear index. What are we seeing right now this week?
Yeah, well, right now the fear index looks pretty scary. The fear index is confirming support at a higher level. It made a significant rise along with the market sell-off. And my characterization of the move is that it looks more deliberate than the one before. In July, it was a run for the hills, spike in fear. And right now, what I'm seeing is the market kind of gearing up for a sustained move higher, which could lead to a significant correction in the market. In this environment, the S&P 500 could fall 7.5 to 10% easily, and up to 20% before it's all said and done.
Those are some scary numbers for investors to be looking at. What can you do in an environment like this as an investor to try and protect your investments, but maybe also continue investing and trying to make a profit during this kind of economic time?
Well, you want to start with a good, diversified portfolio that includes some buy and hold, no-brainer stocks. Right now, you're going to want to look at fundamental quality and capital returns. That includes some possibly low beta stocks to kind of mitigate some of that downside risk. But ultimately, what I see happening is another buy the dip opportunity. The difference between now and the last few is that this dip could be much larger than what we've seen over the last 2 years. Um, but I think investors should just stay the course, build up some capital, target their favorite buy and hold stocks, and buy them when they present opportunities.
We're just about 10 days away from that Fed rate cut, at least the one that's expected. Will whatever comes out of that announcement really impact the market again, or is what we're seeing just a lead up to that decision?
I think it's just a lead up to the decision. The CPI report suggested that the shift in FOMC policy was really a sell the news event. The sell off yesterday kind of confirms that idea. What we're going to want to see the FOMC do this month is to cut rates more than the market expects, which is probably not going to happen because there are still signs of fundamental strength in the market, including the labor data. The labor data has been very resilient, gives the FOMC really no reason to need to cut rates. So, with inflation still above their target rate and only falling ever so slowly, it's possible they'll hold off for another month and they may not cut rates at all.
We will have to hold on and see what the market does if that is the case. Thank you, Thomas, for diving into this week's market dip and the big sell off underway. Be sure to like and subscribe as we continue to follow all of the market moves right here on MarketBeat. Thanks for joining us, and as always, happy investing.